Let's just take a step back for a second and talk about how these strategies are usually put together, because that's kind of where the problem lies.
Gotcha.
So typically when people are implementing these strategies, they're often using what are called quantile approaches. So you might like rank all the assets in a certain universe, like stocks or bonds, based on some signal like, price to book ratio for value or past returns for momentum.
Yep.
And then you go long on the top slice, like the top 30%, and
Uh-huh.
short on the bottom slice, the bottom 30%. Or you might use like a linear weighting scheme, where the size of your position in each asset depends on how strong its signal is.
Mm-hmm.
But the key point here is that both of these approaches kind of treat all the assets within those groups as equal.
Yeah.
They don't really consider how individual assets within those groups might be interacting with each other. And that's where these base pairs come in.
Okay, so what exactly is a base pair in this context?
Well, it's kind of like the most basic building block of any signal-driven investment strategy.
Okay.
Instead of looking at like a whole universe of assets, a base pair portfolio is just a long, short position between two specific assets. And that position is driven by the signal you're using for your strategy.
Gotcha.
So for example, if we were using a momentum strategy for currencies, a base pair might be going long on the currency that's performed the best recently and short on the currency that's performed the worst. And that's it, just those two. And what's really cool is that the authors of this paper show that any cross-sectional strategy, which is any strategy that sorts assets based on some signal, can actually be mathematically broken down into the sum of all its possible base pair portfolios.
Wow, that's fascinating.
So all those like big, complex, long-short strategies we hear about are really just a bunch of these individual base pair bets combined together